Yesterday, a momentous announcement was made to the world. The banking institutions had conceded defeat, and the era of price manipulation had come to an end. However, today the communication lines have fallen silent. The spot price for silver stands firm at $62.30. It has held its ground, refusing to falter. On paper, your wealth has never been greater, but attempt to utilize it. Try to take those $62.30 and purchase an ounce of physical silver right now. I challenge you. Venture to the most prominent wholesalers across North America. Reach out to the esteemed refineries situated in Switzerland. Contact the mints operating in Australia. Do you have any inkling of what you will encounter? You will be met with the distinct sound of a dial tone, or perhaps a pre-recorded message stating, "Due to unprecedented market volatility, we are temporarily suspending new order acceptance." We had foreseen this possibility. We cautioned you that when the price finally transcended commercial suppression, the ascent would not be a seamless journey. We foretold that it would dismantle the established system. Indeed, the system is now fractured. What we are presently observing at $62.30 is not a scarcity of supply, but rather a profound crisis of liquidity. The logistical framework for physical silver has completely collapsed. Refineries are suspending operations. Wholesalers are rescinding agreements that were finalized just yesterday. The United States Mint is reportedly operating under an indefinite allocation status. The reason? The price escalated far too rapidly. It sounds preposterous, doesn't it? One would logically assume that elevated prices would stimulate increased market supply. This is the fundamental principle of basic economics. High prices typically incentivize sellers to enter the market. However, the silver market operates far beyond the simplistic tenets of introductory economics. It is a precarious edifice constructed upon leverage, akin to a house of cards. At $62.30, the very hedging mechanisms that enable refineries to function have transformed into a self-destructive pact. Within this presentation, which may well be the most critical warning I have ever issued, I shall meticulously dissect the reasons behind the supply chain's paralysis. I will guide you through the intricacies of the refiner's predicament. I will demonstrate precisely why possessing fiat currency in your possession at this juncture represents the most perilous situation imaginable. Furthermore, I will elucidate why $62.30 is not indicative of the actual price, but rather the final recorded position of a vessel that has inexplicably vanished from radar. If you are holding out for a market dip to make a purchase, you are already adrift and beyond salvation. The opportunity has not merely closed, it has been sealed shut. This is the very embodiment of a nightmare scenario. Let us establish the current state of affairs on this day, December 11th. Typically, a market comprises two distinct participants: the buyer, indicating their willingness to pay, and the seller, stating their acceptable price. When these two converge, a transaction occurs and liquidity is established. However, as of this morning, the silver market has become one-sided, with only bids being present. Millions of individuals are poised with capital, eager to acquire at prices of $62, $65, or even $70. Yet there are no corresponding asks. The sellers have entirely exited the marketplace. This morning, I received a report from a key contact at one of North America's most substantial precious metals distributors, located in Texas. This is an entity that processes millions of ounces monthly. He communicated, and I quote, "We have ceased all sales. Our hedging facility with the bullion bank has reached its absolute limit. We are unable to replenish the metal we dispense. Consequently, our website will remain offline until further notice." Reflect on this for a moment. Their entire business model revolves around the sale of silver. Silver is commanding an unprecedented all-time high, yet they are refusing to engage in sales. The underlying reason? The inherent risk associated with replacement. Envision yourself as a dealer. You possess a substantial quantity of silver eagles on your premises, acquired 3 months ago when silver was priced at $30 per ounce. Today, silver is valued at $62.30. You could liquidate this inventory and realize a significant profit, correct? Incorrect, because upon selling that inventory today at $62 per ounce, you would possess cash. However, tomorrow, should silver ascend to $70, $80, or even $100 per ounce, you would be compelled to utilize that cash to procure new stock to replenish your shelves. If the price escalation outpaces your ability to restock, your business will cease to exist. You have effectively exchanged an asset that is appreciating in value for a currency that is actively depreciating. Consequently, the astute dealers, Those who navigated the turbulent waters of 1980 and 2011 have recognized this inherent trap. They are currently withholding their own inventories, making a strategic decision that the physical metal holds greater intrinsic worth than the immediate profit margin. This action engenders a significant depletion of liquidity. The metal itself still exists. It is stored in vaults and secured in safes, but it is simply not accessible. It has transitioned from mere inventory to a strategic reserve, and this is having a cascading effect on you, the consumer. If you visit platforms such as AppMex, JM Bullion, or SD Bullion at this precise moment, you might encounter pre-order options. The projected shipment dates are often set for February of 2026. I strongly advise against clicking that button. What you are essentially offering is an unsecured loan to a dealer who demonstrably lacks the physical inventory. At the current valuation of $62.30, the tangible link to physical silver has been irrevocably severed. The genesis of this predicament can be traced to the apex of the supply chain, the refineries. This is where the technical intricacies become paramount. A thorough comprehension of this process is essential to grasp why the $62.30 mark proved to be the system's undoing. The prevailing misconception is that refineries such as Heraeus or Valcambi are speculative entities. Many believe that refiners profit from escalating prices. This is fundamentally inaccurate. Refineries actively abhor price volatility. Here is a simplified explanation of their operational model. A refinery procures raw bullion from a mining operation. Let us posit that they acquire 1 million ounces. The process of refining this silver necessitates a considerable time frame, perhaps 2 weeks or even a month. The refinery operates under a constant apprehension that the price of silver might decline during the refining period. Should they purchase at $62 per ounce, and the price subsequently drops to $50 per ounce, they stand to incur substantial financial losses. Consequently, how do they mitigate this risk? They leverage the futures market. The instant they acquire the physical ore, they simultaneously engage in short selling an equivalent quantity of paper silver on the futures exchange. If their physical holdings amount to 1 million ounces, they will execute a short sale of 1 million ounces of paper silver. This practice is referred to as a perfect hedge. Should the price of silver decrease, they would experience a loss on their physical holdings, but realize a gain on their short position. Conversely, if the price of silver escalates, they would profit from their physical holdings but incur a loss on their short position. Their objective is to maintain a delta-neutral position, focusing on generating revenue from the refining fee rather than profiting from price fluctuations. This operational framework functions effectively when silver experiences minor price movements, such as 10 cents per day. It remains manageable when price shifts are in the realm of 50 cents per day. However, what transpires when silver experiences a dramatic surge of $2.50 within a single day, followed by an additional 50-cent increase several hours later? The inevitable consequence is a margin call. The refinery possesses the physical silver, but that metal is currently undergoing the refining process. It is not liquid cash. Simultaneously, their short position on the futures exchange is hemorrhaging millions of dollars hourly as the price surges towards $62.30. The exchange itself remains indifferent to the fact that the refinery holds physical silver. Their primary concern is the immediate cash required to cover the losses incurred on the paper short position. This constitutes a dire predicament. The refinery, while technically solvent, finds itself severely lacking in liquidity. Therefore, on Wednesday, December 10th, as silver breached the $60 threshold, every major global refinery received an urgent communication from their brokerage firm, demanding immediate remittance of $50 million or facing the liquidation of their position. Where can a refinery procure such a substantial sum of cash overnight? They cannot. Consequently, what course of action do they adopt? They cease all incoming purchases. They halt the acquisition of raw ore from mining companies, as they are financially incapable of establishing a new hedge. And as a direct result of ceasing ore purchases, they discontinue the production of refined bars. This is the precise reason for the complete cessation of the supply chain. The dramatic price increase has fundamentally undermined the hedging mechanism that sustains the operational integrity of the supply chain. It presents a stark paradox. The higher the price ascends, the less silver is actually produced. We witnessed a similar phenomenon in March of 2020 and again in February of 2021. However, the current situation is considerably more severe, as silver was priced at $12 in 2020. At $62.30, the capital demands are magnified by a factor of 5, and the margin calls are correspondingly 5 times larger. The refineries are effectively paralyzed. Until such time as the volatility subsides and the price stabilizes, they will be unable to produce even a single new bar. We are currently observing a global production freeze coinciding precisely with a period of peak demand. Thus, the refineries are rendered immobile. What then befalls the subsequent tier in the supply chain? The wholesalers. These are the entities responsible for acquiring industrial-sized bars and subsequently processing them into 1-ounce rounds, 10-ounce bars, and collectible coins. They serve as the crucial intermediary between the industrial sector and you, the individual investor. When the refineries abruptly halted their order processing this morning, the wholesalers experienced widespread panic. I engaged in a conversation with a source at a prominent minting facility in Florida just 2 hours ago. He described the prevailing atmosphere as apocalyptic. His exact words were, "We have outstanding orders for 500,000 ounces from retail customers who capitalized on the breakout yesterday. We have accepted their funds, but our supplier has just unilaterally canceled our scheduled delivery for next week. We are facing a deficit of 500,000 ounces. We are essentially bankrupt from a technical standpoint if we cannot secure the necessary metal." This reveals a rather unsavory truth within the bullion industry. A significant portion of its operations relies on a just-in-time inventory system. When you place an order through an online platform, it is often the case that they do not possess the specific item you have ordered. They, in turn, place an order with a wholesaler. The wholesaler then procures the item from the refiner. Thus, the entire chain is interconnected and, in this instance, is broken. The individual operating the facility in Florida is faced with 2 stark choices. Either refund your money, thus returning depreciating fiat currency to you, or delay the shipment, resulting in the dreaded allocation notification. We are witnessing the latter scenario unfolding on a massive scale today. If you examine your email inbox, you might find a notification stating that, due to unprecedented demand, your order has been postponed. The estimated shipping time is now 4 to 6 weeks. In essence, this translates to, we do not currently possess the silver. We are either hoping for a price decrease to enable us to acquire it, or we are holding out hope that the refineries will resume operations. However, here is the critical point. While the wholesalers are engaged in a desperate struggle to secure inventory, the industrial consumers are actively capitalizing on the situation. Companies such as Tesla, Samsung, and First Solar do not procure 1-ounce coins. They directly purchase bulk bars from vaults. And at the current price of $62.30, they are not engaging in hedging. They are actively stockpiling. They comprehend the implications of the refinery freeze and grasp the underlying mechanics that I have just elucidated. They understand that if the refineries cease production for an extended period, their solar panel assembly lines will grind to a halt, a situation they cannot afford to permit. Consequently, these industrial titans are circumventing the wholesalers. They are offering premiums that smaller retail coin dealers simply cannot match. They are prepared to pay upwards of $65, $70, or even $75 per ounce for immediate delivery of industrial-grade bars. This effectively siphons off the remaining liquidity from the retail market. The wholesalers are being outbid by these technology behemoths. You are now in direct competition for silver with Elon Musk. Who do you believe will emerge victorious in this bidding war? This contagion is spreading with alarming rapidity. By the close of next week, I anticipate that 80% of the online inventory currently displayed will be marked as sold out. The remaining 20% will likely carry premiums exceeding 50%. You will observe a spot price of $62, while Silver Eagles are being offered at $100. This is not hyperbole. It is the logical consequence of a fractured supply chain. Now we must address the legal ramifications. The crucial term you need to familiarize yourself with today is force majeure. This is a French term signifying superior force. In the realm of contract law, it is a clause that permits a company to disengage from a contractual obligation due to an unforeseen event that renders performance impossible. Typically, this clause is invoked in situations of war, natural disasters like earthquakes, or acts of God. However, embedded within the fine print of virtually every bullion dealer's terms and conditions, as well as futures exchange agreements, are provisions that classify market dislocation or extreme volatility as valid grounds for invoking force majeure. With silver trading at $62.30 and refineries experiencing a complete shutdown, we are perilously close to declarations of force majeure. What does this signify for you? If you hold unallocated silver within a pool account, if you possess shares in SLV, or if you hold a futures contract and the entity in question formally declares force majeure, they are not obligated to provide you with the physical silver. They are entitled to settle your contract in cash, and they will determine the settlement price. Consider this hypothetical scenario. Silver surges to $100 next week. The dealer or bank declares force majeure due to their inability to procure the necessary metal. They then issue you a check for the value of your account, calculated based on the closing price of December 10th, which was $61.75. While silver is trading at $100, you receive payment at $61.75, effectively losing $40 per ounce and forfeiting the actual metal. And, alarmingly, this is perfectly legal. This is precisely why I have vehemently advocated for years. If you do not physically possess it, you do not truly own it. At the current price of $62.30, counterparty risk represents the most significant threat you face. The system is actively seeking an exit strategy. Force majeure is precisely that escape hatch. We are already witnessing the initial indicators. The Shanghai Gold Exchange has just implemented a margin requirement increase to 20%. The COMEX is highly likely to raise margin requirements this evening. These represent preliminary deterrence. Force majeure, however, is the ultimate barrier. If the refineries remain non-operational for an additional week, and if the margin calls go unmet, we will witness the first major default. It might initially be a smaller mint, followed by a regional bank, but once that initial domino falls, the cascade of cash settlements will commence. You do not want to find yourself in the position of a creditor to a bankrupt bullion dealer. Your objective is to be the rightful owner of the physical asset. This brings us to the emergent reality of the market. We are presently witnessing a fundamental divergence. For the past 4 decades, the spot price and the physical price of silver have been inextricably linked, moving in tandem. While there may have been a minor premium, perhaps $2 or $3, at the current valuation of $62.30, they have effectively divorced. The spot price is progressively losing its relevance. It has become merely a numerical representation on a screen, potentially signifying a 5,000-ounce bar that may not even exist, and traded by high-frequency trading algorithms. The true price is that which can be negotiated in a clandestine transaction. It is the price that a solar manufacturer agrees to pay a refinery. It is the price you will pay your local coin shop. At this moment, that price is closer to $80. If the spot price is $62, and you are unable to acquire silver for less than $80, what then is the actual price of silver? It is $80. The figures displayed on the screen are deceitful. This disparity is particularly perilous because it creates a false sense of security. You observe the screen and note a perceived price retraction to $61 or $50. You might think, I will wait and purchase then. However, the premium on the physical metal has simultaneously increased by $2. Consequently, even though the spot price has ostensibly decreased, the actual cost of acquisition has risen. This phenomenon is known as backwardation in the physical market. It signifies that immediate possession of the asset is valued substantially higher than a future promise of the asset. Why is this occurring? Because trust has utterly evaporated. No one places confidence in the COMEX to deliver. No one trusts that the refineries will reopen promptly. No one trusts the enduring value of the dollar. When trust disintegrates, premiums skyrocket. We have witnessed this in Venezuela and in Zimbabwe. When a currency collapses, the price of gold and silver not only escalates but also vanishes from the official market, trading exclusively in the black market. We are not yet fully immersed in that phase, but the cessation of orders at major refineries represents the initial step toward this black market paradigm. The official channels are becoming increasingly congested. The unofficial channels are where the actual movement of metal is occurring. And if you are not actively engaged within the physical market at this present moment, if you continue to rely solely on the ticker displayed on CNBC, you're essentially observing a phantom. For those who have just joined us, allow me to reiterate with absolute clarity the fundamental premise established in the initial segment. The operational framework of the silver market has fundamentally failed. Refineries have suspended operations due to a catastrophic breakdown in their hedging capabilities. Wholesalers are canceling retail deliveries because they are unable to secure the necessary metal, and the spot price of $62.30 is rapidly devolving into an illusory figure. We have now irrevocably crossed the event horizon. In astrophysics, the event horizon represents the boundary surrounding a black hole, where the gravitational pull becomes so intense that not even light can escape its grasp. Once this threshold is crossed, there is no possibility of reversal. The trajectory of the vessel cannot be altered, nor can a distress signal be transmitted. You are irrevocably captured within the gravitational well. The silver market breached its event horizon this morning at precisely 9 o'clock a.m., when the major Swiss refiners ceased responding to telephone inquiries. So, what lies ahead? If you believed the turmoil of the past 24 hours was extreme, you have witnessed merely the prelude. What is to come is the unobtainium phase. In the forthcoming 40 minutes, I shall meticulously chart the trajectory of this unfolding crisis. I will delineate a minor market pivot that is poised to precipitate the most significant stock market bubble since the dot-com era. I will expose the government's inevitable reaction, the regulatory measures they will attempt to implement to stem the bleeding, and, most crucially, I will provide you with a definitive roadmap to $100, not as a theoretical projection, but as a mathematically verifiable outcome driven by the systemic collapse we are currently experiencing. Prepare yourselves. The easy phase has concluded. The arduous journey commences now. To comprehend silver's trajectory beyond $62.30, you must abandon your conventional trading mindset. You must adopt the perspective of a survivalist. You must understand the psychology of unobtainium. Unobtainium is a term frequently employed in engineering and science fiction to describe a material that is ideally suited for a particular application but is virtually impossible to acquire. When a commodity ascends to the status of unobtainium, its price exhibits a parabolic trajectory. It does not increase by 10% daily. It doubles and then doubles again. We witnessed this phenomenon with rhodium in 2020. Rhodium, a critical component in catalytic converters, experienced a severe supply constriction. Manufacturers were thrown into a state of panic. The price surged from $2,000 to $29,000, representing a 14-fold increase. The rationale was straightforward. Automotive manufacturers required rhodium. Without it, they were incapable of selling their vehicles, which typically retail for $50,000. Consequently, expending $29,000 for an ounce of this precious metal was considered a bargain when compared to the catastrophic cost of halting their production lines. Silver has now entered this analogous phase. Consider the solar energy industry. I alluded to this previously, but let us delve deeper. A TOPCon solar panel manufacturing facility operates continuously, 24 hours a day. The initial investment to establish such a facility runs into the billions of dollars. It employs thousands of individuals and is bound by contractual obligations to deliver gigawatts of power to governments. Should the supply of silver paste be interrupted, the factory will cease operations. The workforce will be sent home. Contractual agreements will be breached. The stock price of the solar company will plummet, and government interventions are likely. Therefore, what is the procurement manager at First Solar currently doing? They are scrutinizing the market data. They observe the price of $62.30. They contact their supplier, who informs them, "We have no inventory." Does the manager then calmly state, "Oh, well, I suppose we will simply wait"? Absolutely not. They will react with extreme urgency. They will declare, "I do not care about the price. Find it." They will reach out to competitors. They will contact vaults in London. They will seek out private hoarders. They will offer $70 per ounce. If unsuccessful, they will increase their offer to $80. If still no positive response is received, they will escalate their offer to $100, and only then will someone likely agree to the transaction. This is precisely how the price can spontaneously jump from $62 to $100 within a matter of hours. This is not speculative behavior. It is a manifestation of existential panic. The retail investor, such as yourself and myself, experiences FOMO, fear of missing out. However, the industrial user is driven by FOTO, fear of dying out. FOTO is an infinitely more potent emotion than FOMO. We are already receiving preliminary reports that companies like Samsung and LG are directly approaching mining operations to secure their entire raw ore production. They are endeavoring to circumvent refineries altogether. They are offering to finance the mines in exchange for guaranteed future deliveries. This is the ultimate indicator of unobtainium. The supply chain is being fundamentally rewritten in real time. And what is the impact on pricing during this phase? The price becomes inelastic. This implies that regardless of how dramatically the price escalates, the buying activity does not abate. Typically, high prices inherently suppress demand as consumers cease purchasing. However, in this scenario, one cannot simply cease acquiring the very material that sustains the functioning of civilization. At $62.30, we are situated at the nascent stage of the unobtainium curve. The panic-driven buying has not yet fully materialized. Consider the implications when Apple announces a delay in iPhone production due to silver shortages. Envision the United States military invoking the Defense Production Act to secure silver for missile systems. Only then will you truly witness the scale of a genuine mania. Now, let us address the second wave of this wealth redistribution. If you are unable to acquire physical silver because refineries are inoperable and you cannot purchase futures contracts due to prohibitive margin requirements, where does the capital flow? It gravitates towards the source, the mining companies. For the past decade, silver miners have been the most reviled sector on Wall Street. They have been systematically starved of capital. They have been subjected to intense short selling by financial institutions. They have traded at valuations that defied any rational explanation. It was possible to acquire a silver mine for less than the cash reserves it held. However, today, with silver priced at $62.30, the economic viability of mining operations has transformed into a lottery ticket. Let us perform a simplified financial calculation for a hypothetical mining company, which we shall refer to as Apex Silver. Apex Silver produces silver at an all-in sustaining cost of $20 per ounce. This figure encompasses all operational expenditures, including fuel, labor, exploration, taxes, and all other associated expenses. At a silver price of $25 per ounce, the previous prevailing rate, Apex realized a profit of $5 per ounce. This was a challenging business environment, and they barely managed to remain solvent. However, at a silver price of $62.30, their operational costs remain approximately $20 per ounce. Their profit margin now stands at a staggering $42.30 per ounce. This represents an 800% increase in free cash flow. Has their stock price reflected this substantial gain yet? No, because the market is sluggish and demonstrably irrational. The market is still grappling with the question of whether this price level is sustainable. However, once the quarterly earnings reports are released, and once Apex Silver announces that it has generated more profit in the fourth quarter of 2025 than in the preceding 10 years combined, the stock chart will undoubtedly resemble a vertical ascent. And here is a crucial additional benefit. The halt in refinery operations actually serves to benefit the mining companies. Why? Because the miners possess the raw ore. If the refineries are unable to hedge their positions, the mining companies effectively become the strategic reserve. Prominent industrial purchasers, such as Tesla and Samsung, will directly engage with Apex Silver. Their intention is either to acquire the entire mining operation or to secure a 50% ownership stake. We are poised to witness an intense period of corporate consolidation and acquisitions. Technology firms are acquiring mining entities, automotive manufacturers are purchasing mining companies, and sovereign wealth funds are also investing in the mining sector. This influx of capital will trigger a significant upswing for mining stocks. If you missed out on acquiring physical precious metals and are holding cash without suitable investment opportunities, the mining sector presents your secure harbor. However, and this is a critical caution, judicious selection is paramount. Not all mining companies are created equal. Some have already hedged their future production, having entered into agreements last year to sell silver at $30 per ounce. These companies are in a precarious position and will not benefit from the upward price movement. You must identify the unhedged mining operations, those that are directly influenced by the prevailing market price. Furthermore, consider the geographical risks involved. Recall Mexico, the world's leading producer of silver, with current pricing around $62.30. Do you genuinely believe the Mexican government will permit foreign corporations to retain all of that profit? Unlikely. We are already encountering whispers of a windfall profit tax being implemented in Mexico and Peru. Nationalization represents the subsequent logical step. Consequently, mining companies situated in secure jurisdictions like Canada, the United States, and Australia will command a substantial premium. The shift in focus towards mining companies is commencing now. Informed investors are transitioning from bullion dealers with depleted inventories to the mining exchanges, which offer considerable liquidity. This is where the potential for a tenfold return on investment resides. A crucial discussion is necessary regarding the counteroffensive. Do not entertain the notion that entities like JP Morgan and the Federal Reserve will passively accept defeat. They will not allow silver to reach $100 without a formidable struggle. They have faltered in the marketplace. Therefore, they will now initiate a regulatory conflict. We observed a similar pattern in 1980 with the Hunt brothers. The authorities altered the trading rules. They mandated liquidation-only orders. Purchasing silver became prohibited. Only selling was permitted. Margin requirements were elevated to 100%. It is highly probable that we will witness a recurrence of these measures, potentially within days. Here is the strategy they will likely employ to attempt to suppress the price below $60.30. Tactic 1. The margin detonation. The CME Group will announce an emergency increase in margin requirements. Currently, controlling a futures contract might cost approximately $10,000. They will elevate this to $50,000 or $100,000. Their objective is to force small-scale speculators and retail traders out of the market. They aim to compel you to liquidate your positions due to insufficient capital for the required deposit. Tactic 2. Position limitations. The Commodity Futures Trading Commission will declare a market emergency. They will contend that speculators are artificially influencing the price. They will impose a ceiling on the number of contracts any single entity can hold. However, and this is where the corruption lies, they will likely exempt the commercial hedgers, namely the banks. This means the banks can maintain their short positions, while you are prevented from taking a long position. This constitutes a rigged system. Tactic 3. The threat of a windfall tax. Politicians will begin appearing on television. They will assert that those hoarding silver are jeopardizing the transition to green energy. They will characterize silver accumulation as economic sabotage or price gouging. They will propose measures to restrict the sale of precious metals. Their intention is to instill fear and provoke you into selling. Tactic 4. ETF cash settlement. We previously discussed the concept of force majeure. Pay close attention to the iShares Silver Trust, SLV. They may amend their prospectus abruptly. They might announce, for the sake of fund stability, that they are suspending the creation of new share baskets. This action will decouple the ETF from the actual physical price of silver. The ETF could be trading at $50 while silver is priced at $70. This will effectively trap passive investors. You must be prepared for such headlines. When these events unfold, the price may experience a decline. Silver could plummet from $60 to $55 within an hour upon the release of this news. The media will exclaim, "The bubble has burst. The government has intervened." Do not fall for this narrative. Regulatory measures cannot generate silver. Margin increases cannot create silver. Taxes cannot manufacture silver. All these maneuvers serve only to diminish paper demand. They do nothing to address the physical shortage. In fact, they exacerbate the problem. If silver is taxed, individuals will conceal it, further reducing supply. If speculation is banned, price discovery will shift to the illicit market. The price of silver will no longer be dictated by the CFTC. It will be determined by the physical deficit. Unless the government can magically produce 1.1 billion ounces of silver out of thin air, they are powerless. Their only recourse is to induce volatility. They cannot alter the underlying trend. Therefore, when the regulatory pressure is applied, and it is inevitable, interpret it as a sign of their desperation. It is the death throes of a failing system. Despite the halted refineries and the impending regulations, how will we ascend to $100? Let us outline the trajectory. We are currently situated at $62.30, representing a critical breakout zone. Stage 1, the gamma squeeze, from $62 to $75. This is presently occurring. Millions of call options are in play with strike prices at $65 and $70. Market makers, anticipating that these options would not be exercised, sold them. As the price escalates, market makers are compelled to hedge their positions by purchasing futures contracts to cover the options. The higher the price ascends, the more they are forced to buy. This phenomenon is termed gamma, and it creates a self-perpetuating cycle. This gamma squeeze will rapidly propel us through the 60s. I anticipate reaching $75 within the next 10 trading days. Stage 2, the media frenzy, from $75 to $85. At $75, silver will feature in the nightly news, not just on financial channels, but on general news broadcasts. Silver will achieve record highs. Grandmother's silverware will suddenly be worth a fortune. This will attract the general public, individuals uninformed about deficits or JP Morgan's activities. They will simply observe a rising price trend. They will descend upon pawn shops and invest in ETFs. This influx of capital is substantial and driven by momentum. It will push the price from $75 to $85 purely on speculative enthusiasm. Stage 3. Industrial user capitulation, from $85 to $100. This represents the final ascent. At $85, industrial consumers will realize that the price is unlikely to recede. The temporary surcharges they implemented on their products will become permanent. They will cease to resist the price increases and will commence panic buying. They will issue corporate bonds solely to acquire silver. This institutional purchasing power will overcome the final resistance levels. The price will gradually increase day by day. 88, 92, then 96, and finally, the magnetic pull of $100. Why $100? Because humans are drawn to round numbers. $100 is the equivalent of the 4-minute mile. Once we surpass this threshold, the global paradigm will shift. Silver will no longer be considered a subordinate to gold. It will be recognized as a premier monetary asset. At $100, the gold-to-silver ratio will likely contract to 40-1 or even 30-1. This will trigger a revaluation of the entire asset class. Therefore, the roadmap is clear. The gamma squeeze will propel us to $75. Public enthusiasm will drive us to $85. Industrial panic buying will lead us to $100. This progression will not be linear. There will be corrections of 20% and days of significant price drops. However, the ultimate destination is mathematically assured by the persistent deficit. This brings us to the most critical question, a question that goes unasked until it is too late. When do I sell? You have held your investments for years. You have witnessed the price reach $62.30. If it reaches $100, will you sell? Here is my unconventional response. No, you do not sell your silver for dollars. Why would you exchange the planet's most scarce asset for a currency that is being relentlessly printed into worthlessness? If silver reaches $100, it signifies a collapse in the dollar's value and rampant inflation. Selling for cash at that point is akin to accepting a burning ticket. So how do you realize your profits? You exchange. You play the ratios. Strategy 1. The gold swap. When the gold-to-silver ratio falls below 30, meaning it takes 30 ounces of silver to acquire 1 ounce of gold, you perform a swap. You exchange your volatile silver holdings for stable gold. This locks in your purchasing power gains without reverting to fiat currency. You effectively double your gold holdings at no cost. Strategy 2. The asset swap. You exchange silver for tangible assets. You trade silver for real estate. You exchange silver for income-generating properties. You convert silver into a business. You transition from defensive wealth preservation to productive wealth creation. In 1980, approximately 800 ounces of silver could be exchanged for an average American home. Today, at $62 per ounce, that ratio is still unfavorable. However, at $100 or $150 per ounce, the ratio will normalize. When you can purchase a house with a monster box of silver, that is the opportune moment to divest, not for abstract figures on a screen, but for real, productive assets. Do not be deceived by the dollar sign. $100 is merely an indicator of the dollar's demise. The ultimate objective is to preserve purchasing power. We are living through a monumental historical event. Thursday, December 11th, 2025. The day the refineries ceased operations. The day the supply chain fractured. The day $62.30 became the new floor. The nightmarish scenario I have described is not an attempt to instill fear. It is the stark reality of a market that has depleted its physical reserves. The deficit of 1.1 billion ounces has finally materialized. For those who heeded the warnings and prepared, for those who listened when we were advocating for silver at $25, you are now secure. You have become your own central bank, possessing the insurance policy that the rest of the world is desperately attempting to acquire. For those who remain on the sidelines or are awaiting a price correction, I will reiterate this one final time. The opportunity window has closed. You may find isolated ounces here and there, perhaps by chance at a local pawn shop, but the era of easily accessible silver is over. We have entered the age of unobtainium. Do not permit market volatility to destabilize you. Do not allow government pronouncements to intimidate you. Do not let the paper price distract you from the undeniable physical reality. The banks have been outmaneuvered. The industry is engaged in panic buying, and the price is converging towards its true value. Maintain your resolve, safeguard your holdings, and observe the unfolding events. This is the most significant wealth redistribution in human history, and you are positioned on the favorable side of it. Subscribe.